Hello, friends, and welcome to my YouTube channel Simply Stock. And today I'm going to talk about CARE ratings, a very interesting portfolio stock, what you need to do in this, and whether you should buy it around 400 or not. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about CARE ratings, here's a small request to kindly support me on Patreon. Once you do that, it will help me grow the channel. It will help you also ask me questions on a daily basis. And once you get the $10 membership, you will have access to my portfolio, my watch list, and a number of stocks that I talk to you about on podcast. At least 3 podcasts a week I put up there, and a number of articles. For detailed analysis on number of stocks or one-on-one talk, you can directly email me and we can work things out. Now about CARE ratings, formally established in 1993, it focuses on providing credit rating services across the board. One of the leading credit rating providers and one of the leading players in this space, spread across the country and serves a number of clients from large caps to mid or small caps and even unlisted players. Helps companies in raising capital and investors to make informed decisions through IPOs. So they also help in IPOs and building book building process etc. of major companies. Market cap of the company is around 1300 crores at the moment. If you look at the financial, and these are Q4 numbers of FY20 versus Q4 of FY19, then we have seen a drop of 25% on the sales front, and where the profit has gone down by around 58%. So things have not been that great considering the last couple of years because of there have been issues with companies in a number of companies. There have been management issues and corporate governance issues, and a number of companies have aborted their listing etc. So most of the money that used to come in through listing and from fees etc. has not come in yet. Debt has also increased, and that is a sign in which, I mean, this is one of the biggest reasons as to why most of the people are not willing to get into the stock, and the stock has fallen. Although return on equity of 24% and operating profit margin of 35% is pretty good. If you look at the performance of the stock, then the stock has been a strong underperformer over the years, and we've seen the stock fall from around 12-1300 levels all the way to 300 levels and then has recovered. It fell around 60% from the 2017 highs, and although return ratios are good, but it kept falling because the numbers were not coming in. Numbers could not sustain the same level of profit growth as they were doing in FY15 and 16. Top management, the management is very good with backing of high grade institutions. So in regard to management quality and integrity, there is no issue whatsoever. The company is top class and the management is pretty good. The sales and profits are declining gradually, and that has what has deterred the investors to put in more money into the stock and the stock going higher. And this is probably because a lot of other companies in the consumer space, in electronic space, are doing very well, and so people are looking at them, and people are now looking at a scenario where short term investing is a much better thing, like investing for a year, less than a year or a year and a half, and making money rather than putting money into you can say portfolio type of stocks like CARE ratings. Okay, the sales and profits, as I mentioned, has declined, and it is attractively priced currently at 14-15 times earnings. It has slightly gone up, so it is trading at around 18 to 20 times current earnings at the moment. If you look at the technicals of the stock, then there is strong support around the 350 levels. Currently, the stock is at 407, 410. The short term support lies at around 385 or so. 410 is a strong resistance, 410, 415. It has already run up 30% from the March lows, and the 200 DMA is around 460. But in my opinion, the major up move could begin only above 510 to 515, and that would be a huge up move of 30-40%. But otherwise, at the moment, the stock is range bound and may go lower also. So it is at a cusp of a major resistance at around 410, 415 as I mentioned, and then 460 as a 200 DMA. So taking that into consideration, even for a short term trade, the stock doesn't look extremely attractive at the moment. So what needs to be done? I would say buy close to levels of 400 as it is trading at current levels, and closer to 350 or so, but have a good 8-10 years time frame. Do not have a 1 or 2 3 year time frame. If you want to really invest into it for your children and all, this is a very good stock to invest in, and these are very good prices to get into care rating, because the dividend is also pretty good. So they give very good dividend, and the dividend yield would have increased. I didn't check that, but it would have increased appreciably at 400 rupees. But it all depends on profitability. So the dividend is directly related to profits. If the profits doesn't come in, then there could be no dividend going forward. So you have to take everything into consideration, analyze all the things. But I believe that these kind of stocks, whether it is care ratings or other stocks like BSC and so on and so forth, Gillette, etc., these are portfolio stocks to hold for generations, to hold for 20, 30 years and make a lot of money, rather than holding for a couple of years and then not seeing any movement or any profit, and probably seeing losses on your portfolio. So you have to be aware of this fact. So this was my video on care rating. Please like and subscribe my channel, hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.